Hi, this is AWANI Review. On the show today is Wong. He is the country manager for StashAway in Malaysia. StashAway is a wealth and investment platform. It was founded in Singapore in 2016 and it expanded to Malaysia in late 2018. StashAway is the first robo-advisor to receive a license from the Securities Commission of Malaysia to operate here. Thank you, for being on the show.
Thanks, Cynthia.
Well, let's start with robo-advisor. It was something that was unheard of a few years back. Tell us then, what is StashAway? What are the problems that it hopes to solve?
Sure, yeah, that's a really good point, right? I think people get bombarded with a lot of buzzwords these days. AI, blockchain, and maybe robo-advisor is just one of the many buzzwords, right? But if you think about it very simply, just think of us as a digital fund manager. Fund managers have been around in many parts of the world, in Malaysia, but you mentioned pain points. It's very hard for the Malaysian public to get their money to work, to get their money invested. So what we try and do is really help people invest, but with a very low cost and very low barriers to entry. And we give people global exposure as opposed to just exposure in Malaysia. So the basic problem in Malaysia is that, first of all, they have too much cash. 42% of people's gross financial assets are in cash. There's 770 billion ringgit sitting in deposits alone, including FD. That's a lot of cash. So how do you put that to work, right? And when you look at the landscape in Malaysia, it's very, very expensive. You have ultra expensive unit trusts who are charging 5% sales charge up front, 2% management fee. So we do away with all of that cost. We bring convenience and intelligence to people so they can put their money to work.
So when you first started, you were the first, of course, in Malaysia, robo-advisor. I'm sure there's a lot of what went into just educating the market. What is robo-advisory and how it works and how can you access it?
Yeah. So education comes in many forms. And what we tried to do is not educate people on the new technology, but we educate people on the value that it brings. It's all well and good to have all these buzzwords, but what does it really mean to you as an investor, right? You yourself are an investor. We all put our money to work. So what we tell customers is basically, you want to put your money to work as a digital fund manager, all you have to do is download the app, deposit your money, and watch it grow. It's as simple as that. So the education that we focus on is not so much about the company or the buzzwords and all that, but what we focus on is financial literacy. So we actually have an academy program that we hold almost every week. We held more than 50 events last year, and we open it to the wider public for free, right? So what we do there is we focus on the basics: financial planning, investing 101, how to save for your retirement, how to invest intelligently using ETFs, how our investment framework works. So when we focus on the basics and we give people the building blocks to have them think about their own financial situation, then we hope that one day they'll think, yeah, StashAway is a pretty good platform to put my money to work.
So put your money in StashAway and watch it grow, that's what you have said, but you have to explain a bit more about what exactly goes into, what are investors investing, what kind of assets?
Yeah, so let's start with the basics, right? Each individual should have a balanced portfolio targeted at their own risk level. When you look at the intentions for you to grow your money, whether it's a house, whether it's a wedding, whether it's your retirement, the time frames are different. So because of that, the risk level has to be different. And the portfolios that we invest in are very diversified. So we look at different asset classes and we put it together according to different risk profiles. We're talking about equities across different regions, talk about bonds, REITs, gold. We put it all together and make it very, very easy for people to invest. So how does it really work, right? Once people deposit money with us, we send that money to the biggest financial market in the world, the US, where we choose exchange-traded funds, or ETFs, to put together these portfolios for people.
Let's talk about the selection of ETFs, right? What are the considerations that goes into the selection, and what kind of portfolio are we looking at? Somebody wants to invest in StashAway.
Yeah. ETFs are not new. They are not exotic. They are basic financial instruments that have underlying assets backing them, things like equities, things like bonds, gold, and REITs. And these ETFs have been around for many years. But recently, the movement towards passive investing has really taken off. People are paying attention to how much fees do I pay to my fund managers, and they're looking at ETFs and go, oh, instead of trying to beat the market, why don't I just track the market? So bringing back to the local context. The local context, there are very few exchange-traded funds on Bursa. There are about 10 or 11, but it's still not really taken off in a big way because the issuers or the banks that have come up with these ETFs find that it's more profitable to issue unit trusts, sell it for 5% and get 2% management fee on top of that. And the ETFs don't really get much hype, don't really get much distribution. So what we do is we choose the best ETFs to build the portfolios that we offer. So the first thing we look at is cost, right? Cost is paramount because ultimately the customer or the investor has to pay for it. So we pick the lowest cost ETF, and usually that comes with the ETF being the biggest. And being the biggest means it's the most liquid, so we can sell and buy anytime we want. And also we look at ETFs that are real asset backed. So no synthetics, no options or forward contracts behind it. We look at real asset backed ETFs. Behind these ETFs are actual stocks and gold and bonds. So we don't really like ETFs that are inverse or leveraged or anything like that. We focus on plain, simple, vanilla ETFs. The goal at the end of the day is to build diversified portfolios. You don't need super fancy derivatives to do that. Yeah.
What is management fee does StashAway charge?
Yeah, so we charge a management fee of 0.8%, sliding down to 0.2%. So the more you invest, the less you pay in terms of the percentage. And that is a fraction of what it costs out there, right? Unit trusts charge anywhere from 1.5 to 2% management fee. So we think that by competing on cost, we would open up the investor market.
So let's speak about that. You said that yes, there is a very limited number of ETF selections on Bursa Malaysia. So what StashAway offers really is the access, convenience. But in terms of cost, of course, you charge the management fees, which is low, you said. But you also have, on top of that, you have the ETF fees and exchange rate fees, right? So what is the business model like in terms of generating a sustainable revenue?
Yeah, that's a great question, right? Because obviously the company that you invest in, you want it to be around for a very long time. You're saving for your retirement, you're saving for your kids' education. You want it to be there when you realize these gains. So our plan is to offer really affordable fees to clients. And the way to gain profitability ultimately is to have scale, right? So we need a certain amount of scale within Malaysia and within the region to ultimately break even. And we're very, very well on our way to doing that. You mentioned earlier that we were Singapore HQ and we launched there in 2017. In Singapore, we are already mainstream. Man on the street, lady on the street, just knows StashAway. The awareness is there. And we're seeing that in terms of the assets under management being invested in us in Singapore. So in Malaysia, we are still in the early days. It's only been 1 year. So in the second year, this year, we really, really hope to take off.
Can you share with us the growth numbers from last year to this year in Malaysia in terms of AUM and users?
Yeah. So AUM we can't share, but I will share in terms of the growth and the numbers of investors. So very, very encouraging because again, this is not e-commerce where we sell shirts and shoes. As tough as it is, financial services is even tougher to distribute and sell online. So since our first year, we've grown tremendously, and we had 20 to 25% compound annual growth every month since our launch. So it's been really, really great, and when we're talking about large numbers of people, it's hard to sustain those growth rates, but we're sustaining it because we're becoming more and more mainstream. So in Singapore and Malaysia, we have over 100,000 users opening up accounts with us. So just think of it, 100,000 people, you can fill any stadium, right? That's a lot of people to be managing money for.
Okay, so who is your target group for StashAway?
Yeah, I would say that many niches or many segments of Malaysia can actually benefit from StashAway. We're talking about people who just started their careers. We're talking about savvy investors who have placed and invested their monies overseas. But we are actively going after the white-collar working professional because we think that that market hasn't been served particularly well.
Okay.
You get served really well if you're high net worth. You know,
Correct.
you walk into a private bank, you get full service. If you are someone who has net worth of 1 million or below, it's actually really, really hard to get real service, right? So we are targeting white collar Malaysians who are working very, very hard, but just want their money to grow.
Okay, so from what I understand, from what I read, StashAway focuses on economic conditions when
Yes.
you look at your investments, right? So what are the data points that StashAway monitors, and how can it be ahead of markets, really?
Passive investing just follows the index. When it goes down, you go along with it. When it goes up, you go along with it. There's very little actual intelligence applied to passive investing. You buy an ETF or an index fund and you just hold it. Active investing, on the other hand, involves predicting the future, stock picking, and it comes with very, very expensive fees that we talked about before. So we try and combine the best of both worlds, where we have an investment framework applied to the ETFs that we package and allocate to you. So investment framework is the real thing that differentiates us from the rest. So the thing that anchors the investment framework is economic conditions, because we believe that that is the main driver of asset prices. There are a lot of factors, of course. There's speculation, there's bubbles and things like that, but the real driver of asset classes prices is economic conditions.
So you stay away from sporadic market activity, you stay away from looking
Yes.
into those data points?
Yeah, so we focus on the economic fundamentals,
Okay.
and we don't react to things like Trump tweets or any one isolated incident relating to a particular stock. We really focus on economic fundamentals. So you asked just now, what are the indicators we look at? So we look at things like inflation,
Okay.
industrial production, GDP in general, to signpost where we are in the economic cycle.
Okay.
So if you're in good times right now, where inflation is low and growth is still positive, we'll focus on things like cyclicals, right? More tech, more consumer discretionary, and less bonds and less gold. But you know, the beauty of putting your money with us is if we go into a recession 1 year, 2 years from now, you still need to invest your money and you don't know when we're going to recover out of that recession. So when we go into a recession, we'll automatically change the constituents or the allocation of the portfolio. And we'll give you more bonds, more golds, more REITs, more protective asset classes, so that in the downturn, your portfolio is protected.
So how often does your team readjust your positions? Because I mean, if we look at something like an event like the coronavirus, for instance, right, that will impact global growth eventually. So how often do you reassess your portfolio to look into conditions like that?
So the system is continuously monitoring economic fundamentals. And when the numbers are in and the team sits for an investment committee, we look at the output of the model and see where we are in the economic cycle and whether indeed external events like this coronavirus or the trade wars that were raging on last year really did affect the economy. When it does affect the economy, we'll straight away switch the allocation of the portfolio. The dangerous thing about trying to predict what's going to happen next is that you get caught being too early or reacting too late. So we don't predict. We act according to what we see in the model and the economic data, and then we switch portfolios when we know exactly where we are.
Right. So I just want to find out, so StashAway is currently in Singapore and Malaysia. And tell us about the differences in terms of consumer behavior, risk appetite. What are Malaysians looking at? What are they not looking at compared to our counterparts in Singapore?
Yeah, actually, the biggest misconception is that people think that the Singaporean public's financial literacy is higher than Malaysia. Actually, on the ground, retail is about the same. Institutional level, we're talking sophisticated clients. Of course, Singapore is advanced. But if we're talking about men on the street, Malaysia and Singapore, in terms of education and financial literacy, is not very different. The key difference here between Malaysia and Singapore is that Singaporeans tend to do their homework, tick their boxes, do their research before they invest. Malaysians like new things. So before knowing all the facts, they like to jump in, try new things, and once they try new things and they see it go up and down, then they'll ask questions. So it's very different. But that's what makes Malaysia unique, right? Another thing about Malaysia is that there's obviously not one homogeneous class, right? Malay investors will invest very differently to Chinese or Indian investors, right? Different people have different options. So ultimately, we have to deal with that melting pot. We have to deal with that diversity, and that's why actually we have a very significant customer service team that picks up the phone with less than 8 seconds, answers your WhatsApp within 2 hours, answers your email on the same day. So great customer support for people that need help with their money, have questions about their money, is really important, and we have that.
You have the ongoing cost of acquiring more customers, acquisition cost. You have ongoing cost of servicing, but in terms of yield on the revenue is relatively low. What is the strategy here?
Yeah. So obviously, as a startup, right, we are trying to disrupt the market. You just look at where ride-hailing was 7 years ago, where e-commerce was 5 years, 6 years ago. And financial services is one of those things that is very hard to disrupt because of regulation and how much power the banks have.
Yeah.
So obviously with our low-cost model, we believe that we will win in the medium term. So we really need that scale. And we're talking about billions of ringgit, billions of dollars to, obviously we'll break even before then, but to really get our investors a good return on investment. So at this stage, we are backed by very sophisticated investors. So in Singapore, where we do our fundraising, we were backed at the seed and at the Series A level by a very sophisticated family office called Asia Capital, Francis Rosario and his family office, who have a lot of experience in banking and working with the Singaporean government to invest their money. So when they backed us, we felt that there was a validation of the model.
Okay.
And then late last year, we also got the backing of 8 Roads, which is Fidelity International's venture capital arm. And they led the round, and the total round was $12 million. And we are relying on that at the moment to really scale up quickly.
Okay. So in terms of scaling, besides Malaysia and Singapore, are there plans to go into other parts of the region?
So we don't like to be just a jago kampung, right? Look at ASEAN and markets that were necessarily just close to our heart, right? We look at things like the regulatory framework. Are the regulators ready for a player like us? And then secondly, we look at the wealth market. So we look at how much assets under management certain countries have, and that makes it attractive for us or not. So we are actually on our way to Thailand and a few other Asian countries to really grow in terms of our next step. But here in Malaysia, it's obviously still very early days. It's only been over a year, right? So this year we really think your growth is going to be exponential, and we're going to be mainstream very, very quickly. So with successive growth in each country, that gives us more confidence that the proof of concept works and the business model works as we go into new countries around the region.
But this space in Malaysia is heating up this year especially. In Malaysia, we already have 3 robo-advisors, including StashAway, and there are 2 more coming in this year. One is Australian-based Raise Invest and Thailand's Robo-Wealth. What are your thoughts on this increased competition?
Yeah, we never expected to operate as a monopoly, all right? So we know that competition will come in many shapes and forms. So having more competition and acknowledging that there are more direct competition in this space, I think is good for the consumers, because they will wake up to look at the options that they have at hand and go, wow, these options we have are really expensive and really not good for my buck. So let's look at new robo-advisors to put my money to work. So I think diversity and choice is definitely a good thing for the consumer. But I will say that even with these new robo-advisors in the market, the biggest competition here is still the banks, right? They have immense distribution, they have great branding that they've built for many, many generations. So going up against that is very difficult. And we mentioned just now that Malaysians have a lot of cash, right? So that proves to to us that there's a huge market, and we're not that concerned with a handful of competitors because ultimately is a huge market for all of us to compete. Yeah.
So your competition is not from your peers, but incumbents are also looking into getting into the robo-advisory space. For instance, I think Vanguard in the US has a segment for robo-advisory. For instance, I read their, I think it was the recent financial results. They're looking to partner with one of the largest Malaysian incumbent banks here in Malaysia. So what is the strategy there for StashAway? Are you planning to have partnerships with incumbents?
Yeah. Partnerships is one of those areas that startups can really look at to scale very quickly. And working with incumbents is never easy, but if you strike that balance between the commercial part, where it really works well for both parties, then it really makes sense. Of course, being the new kid on the block, the really shiny thing in the market, all the banks have been, we've been talking to them, they've been kicking our tires and checking out what we have to offer and whether they can work with us. I will tell you that it is really hard to strike that commercial balance because they are making so much money from distributing very expensive products that it's very hard to take that leap of faith to cannibalize your own business. So I acknowledge that they have legacy profit centers, right, that they're sitting on, which is very hard to cannibalize. So never easy for them. We are looking at different partnerships, but it really has to make sense to both parties and most of all the investor. The last thing we want to do is say, hey, we're working with a bank, but by the way, we're going to charge you a sales charge just to get distribution going.
Right.
So we hold that as our North Star. We really want to serve investors well. So whatever partnerships we do with an incumbent, with anyone really has to look after that investor.
So Waikan, you have quite a wealth of experience in capital markets and investment. You were with Khazanah.
Yep.
You were with Affin and briefly in Australia as well with Premium China Funds.
Yep.
Tell us about yourself. What led you to make that jump from a sovereign wealth fund or corporate sector to a startup?
Great question. For anyone out there who's thinking about a career in startups, I think it's never been more exciting to work for a startup, whether it's an existing industry or a very new industry. When it comes to fintech, the space is really heating up. E-wallets, investing platforms, digital banks are all on the horizon. Some of them are already here. So if you're thinking about a career in fintech, now is a really, really good time to apply your skills. For me personally, I was very happy as an investment banker. My friend in Singapore actually told me about this particular opportunity. But the real reason I took the plunge was that when I tried the platform myself, I really liked it because I knew that the industry, the banking industry, was stacked against the normal investor. So being part of the industry myself, so I knew that it's very hard for the investor to put their money to work. So when I looked at this app, I thought I can really help build a business around this, and that really helped me make the decision. One thing, looking back now, that I learned about working with sophisticated investors or the banks is that not all investors are created equal. The man on the street is really neglected because the big funds and the big investors out there get all the attention. And ultimately, it's really hard for the normal investor to put their money to work. So ultimately, we are trying what we can to level the playing field. And I know that coming from the industry, that it's actually, it's harder than it seems, for people to put their money to work. So we are here to try and level that playing field.
If you look at household debt in Malaysia, it's relatively high. It's high, I think it's, low 80s now, 82%. I know that StashAway targets people who already have funds invested in traditional instruments, but looking at the general trend that we're heading, Malaysians are really borrowing too much money, and disposable income for a big segment of Malaysia is still quite small. Is that something that StashAway looks into?
So when it comes to household debt increasing, I think it has actually moderated somewhat, so it stopped climbing. It is at quite high levels, but we're not at a level where, say in the US during the global financial crisis, the credit crunch, where it was actually above 100%. So I think the regulators have done a very good job limiting the growth of borrowings in Malaysia, especially when it comes to real estate. So, but just some general advice for people who have too much debt. I think it's really about paying yourself first, getting rid of your credit card debts, your PTPTN loans, before you even look at investing. After you have done away with your debt barriers already, then you should really look at your safety net. A safety net means 3 to 6 months in cash and don't touch it, and then another 3 to 6 months in liquid investments. So things that you can sell within the week, right? That you can really use to supplement yourself. So that will build a good basis for your financial health. After you do so, then only look at investing, because if you have too much debt, you're just going to be in this cycle where you continuously look at money to pay off your existing loans. And it's very difficult, but once you're out of that, don't go back, right? Create a safety net for yourself first.
All right.
Yeah.
Just one final question. How do you think the wealth management industry will change in the next 5 years if you look at Malaysia?
Good question. I think what it means to the investor, the retail investor, the man on the street, I think ultimately they will have more choices between different platforms, between different instruments. I think the industry, the incumbents, are also trying to digitize. For example, we saw EPF offer iInvest. It's a great platform for you to put your EPF savings with a fund manager at much lower rates. It used to be 3% sales charge, now it's 0.5 to 0 sales charge. So that's a great effort by the EPF to digitize that part of the business so that people can invest and ultimately get more returns because the fees are lower. So I think digitization will be a huge theme, but what it really means to investors is lower cost, more convenience, and I would say more choice. And more choice is definitely a good thing. So do your research, understand how it benefits you. Don't just be swept away by hot trends and shiny things. Do your research, find out what it really means to you, and then make the right decision.
All right. Thank you so much, Wai Ken. Great to have you on the show.
Yep, thanks, Cynthia.